Thinking of buying REITs? Well, there's 3 reasons why you might want to reconsider. Fundamentals, the prices, and interest rates are all pointing to one conclusion, and it's not a good one for investors. So I recently got a video viewer asking me about REITs, and it's actually something I get asked a lot by Facet members as well. So we're going to cover what is a REIT and also what I think of investing in REITs right now. So we'll start. The acronym REIT stands for Real Estate Investment Trust. It's actually a special kind of legal entity created by Congress in 1960. There's basically only 2 rules that define a REIT. First, it has to invest in real estate, so that part's pretty easy. But it also has to pay out at least 90% of its profits to investors in the form of dividends. So the advantage to the company, if they can do this, is they do not have to pay tax at the corporate level. Taxes only wind up getting paid by individual investors when the dividends get paid out. Now, REIT can invest in any kind of real estate. You got things like shopping centers, office buildings, apartments, warehouses, even things like cell phone tower companies and data centers have been organized as REITs. So REITs can also invest in real estate related debt. Now, REIT can be public, where it trades on the exchange. You can just buy it in your brokerage account, or they can be private, which means you're probably only able to buy and sell at certain times and probably also with certain restrictions. Now, I'm not a big fan of investing in REITs right now, and there's 3 reasons, as I mentioned before: the fundamentals, the price of the REIT stocks, and interest rates. But first, the basic fundamentals, they're just not very good. So despite everything we're hearing about returning to office, vacancies in office buildings just keep going up. According to Moody's, 20.4% of office space is currently sitting empty, and that's an all-time high. Apartments, which are usually called multifamily in the real estate investing world, are doing better. So vacancies there stand at 6.3%, definitely a lot less worrisome than office. But that vacancy rate has been steadily rising since 2021 and is currently at its highest level since 2010. Now, when vacancies are high, it becomes very difficult to raise rents. Property owners want their buildings full, and raising rents isn't going to help fill that empty space. So we're definitely seeing that in the data. So, for example, apartmentlist.com publishes a national rent report, and the median apartment rent for new leases has been flat to slightly down since early 2022. So if you've got occupancy declining a little bit, maybe rent rates are flat to down, all that makes it really hard for companies to get revenue and profit growth. Now, unfortunately, I don't see this getting better anytime soon, and that's because the supply of new buildings continues to be very robust. So according to real estate research firm Yardi Matrix, there'll be over 536,000 new apartment units coming online in 2025, and that would be an all-time record. So you've got an increasing number of empty units. You're already struggling to get rents to go up, and on top of that, we're going to get a record number of new apartments that are out there for lease. And by the way, some of this new supply in apartments is coming from office buildings being converted to apartments. That's something that's being encouraged by a lot of local governments. There'll be an estimated 71,000 new apartments coming online in the U.S. from office conversions in 2025. I would guess that keeps going up in subsequent years. Now, to be clear, if all this helps make housing more affordable, that may very well be great news for society. It's just not great news for investors in real estate. So all of that is what I mean when I say the fundamentals for real estate aren't great right now. Now, my second big concern is the price of these stocks. Any sector that's struggling can still be a good investment if the stocks are cheap enough. And despite pretty severe underperformance from REITs over the last 3 years or so, it isn't clear that REIT stocks are in fact cheap. So one way to think about this is to look at the dividend yield of REITs. So dividend yield just means the amount of dividends these stocks are paying divided by the share price today. So in other words, it's kind of how much income are you getting from these stocks for every $1 you invest in them. So if these stocks were cheap, you'd expect the dividend yield to be relatively high compared to history, but actually it's the opposite. So today, the dividend yield of the MSCI REIT index is almost exactly 4%. And that's roughly equal to the average dividend rate over the last 10 years. So, kind of mediocre value, I guess. But that doesn't tell the whole story because today, general interest rates are a lot higher than they've been for most of the last decade. So a slightly more sophisticated way of looking at this is to compare the dividend yield of REITs to something like the 10-year treasury bond yield. This is something that traders call a spread. So on that basis, the REIT yield has been, on average, about 1.4% more than the 10-year treasury over the last decade. However, today, the REIT yield is about 0.3% less than the 10-year treasury. So to me, this means that REITs are actually pretty expensive despite all of those fundamental challenges I mentioned before. And just to put this into context, in order for the dividend yield on REITs to get back to its historic average on that spread basis that I mentioned a moment ago, the price of REIT stocks would have to decline by 26%. Now, I will mention that this price element is potentially better in the private real estate market. So in other words, I think there's probably some good deals to be had on individual properties out there, maybe from distressed sellers and what have you. And I suspect that private real estate funds are in a better position to find those deals than the public REITs are, especially if the fund is seeing inflows. Now, the third element that makes me concerned about REITs is interest rates. So real estate investing generally involves borrowing a lot of money. And when interest rates are high, the higher cost of borrowing eats into the return on any real estate investment. So it makes sense that rising interest rates tend to be a negative for REIT stocks. So we can see exactly this by looking at trading in REITs over the last couple of years. So we take every month since the end of 2020, REITs had an average return of plus 3.3% if the 10-year treasury yield declined in that same month. So in other words, interest rates fall, REITs do great, all right? But the opposite is also true. So any month where the 10-year treasury rate rose, REITs lost an average of 1.5%. Now you can slice this data any number of ways, but no matter what you do, you're going to come to this inescapable conclusion that a bet on REITs is a bet on interest rates declining. Now, if you've been watching my prior videos, you know that I'm not super optimistic that interest rates decline anytime soon unless the economy goes into a recession. Now, I guess in a recession scenario, I don't know that I would bet on REIT stocks going up, but I could see them maybe outperforming other kinds of stocks due to this interest rate benefit they would get. But for me, that kind of makes REITs a one-way bet. I think the sector only outperforms in that one scenario and struggles in most other scenarios. And so I think there's better ways of putting some defense into your portfolio that have a more attractive risk-reward relationship than REITs do. But hey, are you invested in REITs? Do you have a different argument for why they might do well? Put a comment in the comment section. I'm happy to respond to anything I see there. And if you like this content, we'll be coming at you about once a week with thoughts on what's going on in the market, news from the White House, news from the Fed, what have you, as well as these kinds of responses to things we see from viewers. So hit that subscribe button. You'll be the first to know when we've got a new video out. I'd love to see you again.